It has always been said that revenue is vanity, profit is sanity, but cash is king. This powerful truth sets the stage for this module, which transforms pricing, cost, and volume into actionable decisions for executives. Welcome to the core of financial modeling, profitability analysis. Until now, we've been on the defensive, calculating costs and making sure cash flow remains steady. In Module 5, we shift gears to offense, empowering you to drive growth and profitability. This module goes beyond simple subtraction, sales minus costs, to focus on strategy. You will discover how to leverage the three key drivers of shareholder value: price, volume, and cost structure. By the end, you won't just be reporting numbers, you'll be forecasting the business's future health. You'll create a dynamic model that answers the CEO's most pressing question: how do we make more money? So, if you want to know which products to push, prices to raise, or costs to cut, this module equips you with clear tools and confidence. From basic markup rules to advanced profit scenarios, you'll finish by building a sleek profitability dashboard ready for any meeting. Ready to turn insights into action? Let's unlock profitability and drive real business impact. Pricing strategies in Excel, markup, margin, and target profit. Understanding the difference between markup and margin is crucial for making smart pricing decisions. Many beginners mix these up, which can lead to costly mistakes. Here's a clear breakdown. Markup. This is the amount you add on top of your cost, commonly used in retail. Simply put, it's a cost-plus calculation. How much above cost you price your product. The formula is price, cost, divided by cost. Margin. Margin defines how much of the final sales price is actual profit. It measures the percentage of the selling price that yields profit. Both markup and margin measure business profit from different perspectives. It is important we understand them so we do not confuse them, because confusing them can lead to wrong pricing of products. A simple usage formula is to use markup when you start from cost and margin when your target is a percent of the selling price. Let's illustrate with our Greenleaf Bakery's classic sourdough loaf. We know from Module 3 that our variable cost per loaf is roughly 1,455 Nigerian nairas. Let's define our formulas as follows. Markup percent equals price, cost, slash cost margin percent equals price, cost, slash price. What price should we charge based on the cost outlay? The markup approach, cost plus if we want a 50% markup on each loaf. Then, the formula becomes sales price equals cost times 1 plus markup percent. Therefore, price per loaf equals 1,455 times 1 plus 50% equals 2,182.50 Nigerian nairas. The margin approach, the executive standard using the same 50% as our gross margin. Let's calculate the price per loaf. The formula is sales price equals cost divided by 1 margin percent. Therefore, price per loaf equals 1,455 slash 1 to 50% equals 2,910 Nigerian nairas. Notice the difference using both approaches. A 50% markup yields a sales price of 2,182 Nigerian nairas, while a 50% margin results in 2,910 Nigerian nairas per loaf. This means that using the wrong formula could cost you 700 Nigerian nairas per loaf. Target profit pricing. This is a cost-based pricing strategy where a company sets its selling price to ensure it covers all costs and achieves a specific desired profit within a given period. It is essentially a reverse engineering pricing system where, instead of asking, "What profit will this price generate?" management asks, "What price do we need to charge to hit our profit target?" This pricing strategy has the following elements. Profit target. This is the amount of profit management wants to achieve in a given period, say, month, quarter, year. Total costs includes fixed costs, rent, salaries, overhead, and variable costs, materials, labor per unit. Sales volume. This is the expected number of units of a product that would be sold within the specific period. Price calculation. Price is set so that the formula net profit equals quantity times price dash unit cost dash fixed costs equals the target profit. For example, suppose Greenleaf needs to hit a total profit of 500,000 Nigerian nairas next month by selling 2,000 loaves. What must the price be to achieve this profit level? Remember from Module 3 that fixed costs equals 1,625,000 Nigerian nairas, variable cost per loaf equals 1,455 Nigerian nairas. Forecast sales volume equals 2,000 loaves, target profit equals 500,000 Nigerian nairas. To compute the target profit price per loaf, we use the formula price sad face target profit plus fixed costs slash quantity plus variable cost price sad face 500 000 plus 1 625 000 slash 2 000 plus 1 455 equals 2,517.50 Nigerian nairas. So, Greenleaf must charge at least 2,517.50 Nigerian nairas per loaf to hit its targeted profit goal for the period. We can also use Goal Seek to calculate the price as follows. Set up the required variables accordingly, as shown in the Excel sheet. Enter the profit formula in the target profit cell using the formula for calculating net profit, which is price minus unit cost times quantity minus fixed cost. Go to the Data tab. Under Forecast Group, select What If Analysis and Goal Seek from the drop-down list. In the dialog box, set the following. A. Set cell equals select the target profit cell. B. To value equals 500,000. C. By changing cell equals select the price input cell. Goal Seek will arrive at a suitable price to achieve the target profit in seconds. As you can see, the price achieved by Goal Seek is 2,517.50, which is the same as we calculated above. Never confuse the cost basis, markup, with the revenue basis, margin. Excel handles both, but your strategy dictates which one you use.